Hi, welcome back to your 5-minute Seattle real estate update. It's TC Wu here, and we cover everything you need to know as a property owner investor in the greater Seattle area. Please subscribe so you can get our weekly 1-minute updates as well. Well, I don't know what the best way to put this, but the winter is coming. What comes with winter is a lot of uncertainty. With all the craziness that's going on, the buyers and sellers are left scrambling to figure out what is their best course of action before the end of the year. So this is what we're seeing in the market right now. As the outlook of our economy looking dim, with the stock market having taken a nosedive, the Fed poised to be very gung-ho about keep raising the interest rate, a lot of the major employers started freezing hiring, and economic uncertainty from overseas such as Europe or China, buyers are growing increasingly more conservative. What that means for real estate today is that the buyers are becoming more and more unwilling to pay what the sellers are asking for. However, many buyers also find themselves in a dilemma because they feel pressure from knowing that the interest rate will continue to go up. On the other side of the fence, for the sellers, there are two opposing forces at work. First, price decline. Remember towards the end of last year, we're only talking about price deceleration and not price depreciation? Well, we're officially in the depreciation phase. In fact, the median home sale price in King County has decreased by 12% just from May this year. Anticipating more downward pressure on the home prices in the future, sellers who are motivated definitely are here to make a deal. However, on the other hand, the housing inventory growth has become stagnant, which is the second trend we're seeing right now. We had this huge increase in inventory in the summertime, and it has plateaued for the past 3 months. And we're expecting to see the inventory to decrease as we enter into the winter months. There are 3 major reasons causing inventory to become stagnant. One, as seller sentiment grows less optimistic and the holiday season is on the horizon, many sellers who don't need to sell simply decide to wait or hold on to their properties. 2, with historical low interest rate over the past few years, many sellers who purchased or refinanced were able to lock in a low interest rate, which discourages them from making a move. 3, the job market is still strong. So long the sellers are able to make their mortgage payments, it doesn't hurt to just hang on to their properties and continue to enjoy the low interest rate, especially if they have equity in their homes already. Many people are referring today's market to 2008, where the market was flooded with foreclosures and short sales. However, today's market is quite different, in my opinion, from 2008 in a couple of major ways. First, lenders have become a lot more stricter with their underwriting guidelines. Back then, it was easy to get a so-called ninja loan, which are loans that require no income, no job, no down payment. Number 2, in 2008, because the low or no down payment programs, a lot of homeowners became instantly underwater when the price starts to go down. Versus today, we have historically high amount of equity in people's homes. According to CoreLogic, the average homeowner in America has over $300,000 in equity, while in 2008, many homeowners were underwater. The end result, with the inventory growth becoming stagnant, sellers are still getting activities from buyers who are trying to secure a loan before the rate hikes. At the same time, buyers are now less willing to pay what the sellers are asking for due to the growing concern of the market. So what we have right now is almost like a game of chicken as we move into the winter months. I'll be watching the market closely on how things shake out, and I'll be updating you right here on this channel.